We are back with another lesson in Outlier University, and we've got all the students in class today. We've got Ozzy Ian, we've got Paul, we've got Joe, we've got Salty Brad, we've got Mikey Mike, we've got Deep Thought, we've got JC, we've got David, Dave. Yeah, I think we got everybody here. 1, 2, 3, 4, 5, 6, 7, 8. Yeah, looking good. Hey, you know what? What a wonderful long holiday weekend. I hope you guys had a great time. But I got to tell you one thing. I'm a little bit miffed because the YouTube haters have come out hard today. Oh my goodness, the YouTube haters have come out hard today. The video recorded on Friday where we talked about the sell signal on the SPY, the collapsing market breadth and everything else. I'm getting so many comments today, like more than I've ever seen, where it's like, God, you're such an idiot, Chris. How could you? In fact, there were a couple here live. I'm totally calling you out on this, by the way. Sitting in cash while the market goes up. Yeah. Am I the only one thinking this? Wild Stimpy Norwood has to say. And I got to tell you one thing. Follow your plan. If you follow your plan, there is no FOMO. But there's days like today where the FOMO runs rampant. So I really want you guys to like take a step back, for those watching and for our gentlemen here live in class, to just remember the market will move without you many times. It will move up, it will move down, but that doesn't mean you have to chase anything. Once you follow your plan, there's no FOMO. All right. We could get a shirt like Salty Brad has that says no mo FOMO instead of y'all. But yeah, exactly. So don't be stressing on it, right? When you step up to the plate, you got to wait for your pitch. Then you pitch, or you hit it with, I don't do sports. You hit it with the bat, and you get a home run sometimes. And every once in a while you strike out, and every once in a while you get a base hit. But the deal is following your own plan. So don't be suckered into any of those moves. Don't be suckered into anything other than following your own plan. So before we jump too far into it, I really wanted to stress that. Really want to stress that. So thank you guys for all hanging out here with me today. We have lesson 5, and the plan will be to go through the lesson, and then at the end of the class, everybody in the chat will be allowed to ask questions. But I do ask that you keep them on topic for the lesson today. That way we can learn as much of it as we possibly can. So without any further ado, let's go ahead and start class. Now, I will be asking you guys some questions today because I want to hear from you. So let's start here with Outlier University. Let me introduce myself real quick. My name is Christopher Ewell. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009, and this is where outliers like us save time, make money, and start winning with less risk together as a team. Go ahead and subscribe if you haven't already. Now, today is lesson 5, trend following and outlier signals. But before we get into that, we got to look at lesson 4 quiz review, right? We got to go over the answers from last week's quiz. So it doesn't tell who answered what, so I'm not going to be calling any of you very incredibly handsome gentlemen onto the table today. But let's go through these questions real quick. First, the 10 EMA reacts faster than the 10 SMA because, and actually what I'd like you to do is raise your hand and give me an explanation. Who's going to go? Joe, go ahead.
It puts more weight on recent days than historic days.
That's right, yeah. And you can use either one, and I recommend picking one and sticking with it, right? Because you don't want to be second guessing yourself. And I like the 10 EMA because it does move faster on more recent price data, right? I think that's obviously more important because that's what we're trading on is today. Second question, a bullish stack is... Who wants to answer this question? It looks like JC wants to scratch his back and answer this question. Oh, you're on mute, my friend. Go ahead.
If it wasn't for the song, I would have never memorized it. 10 over the 20, 10 over the 20, price over the 50.
That's right. Very good. Now, it doesn't mean that it's the very best entry or very best exit of all time. It just gives you in the way of the trend, and that's what we're looking for here. What does it mean when the price is above all 3 moving averages and they're stacked properly? Brad, go ahead.
That's the bull setup.
That's right. A bullish confirmation, bullish setup there. Whatever the case is you're looking for not just one thing to tell you that the market's moving, but with the 10, 20, 50, That's your short term, your intermediate term, and your long term all moving together. And Nico from the chat, actually, yeah, SMA is fine for sure. That's what I tell you guys, right? Pick what works for you and stick with it. Don't stress over it. ATR stands for, I think Paul wanted to answer this one. Go ahead, Paul.
That's your average true range, which most people use a 14-day period. And basically, that's the amount in dollars that the stock will move in a single day.
Perfect. Which next, ATR tells you, Mikey Mike.
Well, it's right there. It's volatility. And actually, I use it just like the golden ticket. I usually divide the ATR by 2, put it for your half stop below. That's your stop, half ATR below the stop. But it's volatility.
Why do we care about that?
What's that?
Why do we care about the volatility? Oh, go ahead, Brad.
Oh,
Is it for sizing? How many options you can buy, how many stocks you can buy, depending on your risk.
For sure, great answer, Paul.
it's also how we make money in options. The more volatile a stock is, the more money you can make.
That's right. We want volatility, right? Volatility, a lot of people use that as like a dirty word. Oh, that stock's far too volatile for me. But if you're trading in the trend and it's volatile, dude, you're making money, right? It's like a stock that's traveling 100 miles an hour versus a stock that's traveling 5 miles an hour, right? Which one's going to get you to more money faster? Clearly the one with more volatility. Now, you may speed up and slow down a lot more, but it's going to get you more gains at the end of the day, or losses if you're going against the trends. So you need to be keeping that in mind, but you're not going to get paid unless there's volatility, right? If a stock is dead money, you're not going anywhere with it. Next, a great place to put your stop losses would be, now, originally I had the right way or the correct place to put your stop losses, but I said, you know what, a great place, because it doesn't have to be right or wrong. It's a great place to start from. Go ahead, Mike.
I had a question about the ATR again on the volatility.
Yeah.
That's like swings throughout the day, actually, right? If you go into options, and that's the up and down of that stock during that. Okay, so I shouldn't say the day. Maybe the whole time you have your options, you got a 21-day option. That's the movement during that period. It's
the movement over, X number of periods, and the default is 14. And what we're trying to establish is how much does it move? Is it a stock that moves a whole bunch, like $25 a day, or a stock that moves $2.50 a day? Now, you might be confusing this with implied volatility, which is in the options, which is going to come in a couple weeks from now, so don't stress on that. But volatility does change based on your time period, right? If you go to a 5-minute chart, you're going to have different volatility than on a 5-week chart. All right, it's going to be very different in that regard. Too many indicators can cause. I'm waiting on Dave. Dave's sitting over there waiting to answer. Go ahead, Dave.
I'm sitting over here minding my business. Confusion and hesitation. I agree with that answer. Unless you're used to that level of data, you just have too many different data points trying to feed into the same thing. Quite frankly, a lot of them are telling you the same information. It's just displaying it in a different way. So simplicity is always better.
I agree. Well done, Dave. Well done. All right. And last question. The phrase, let the market tell you where it's going, means. Ian, are you up to answering that? We got to give Ian just a moment for the delay there.
So it lets you react rather than predict what the market's doing.
Yeah, perfect. Absolutely. So, of course, there's a little bit of delay to get from Texas to Ian over there. So we'll give him a little bit of slack, but he's totally right, right? You can try and tell the market where it's going, or you can let the market, you can try and tell the market where it needs to go, where it should go, or you can read the market like a book, right? Mm-hmm. I would much rather read the market like a book and then not have to stress trying to say, oh man, I was wrong. Oh, I was right. Oh, I was wrong. I was right. Just The market says I'm going up, the market's going up. Market says I'm going down, the market's going down. Let it be, right? No stress on it. Dave, I think you were raising your hand.
I was just going to make a comment. This goes back to your opening statement today. The market on Thursday closed below the 10. The market Friday closed even further down the 10, just slightly above the 20. So all the haters out there, the market is telling us, as of Friday, close of business, bad things happening. You know, we can't predict what's going to happen in the future, but there were no good indicators Friday leading into this weekend out there. And short of a tweet that went out, the market was telling us, rightfully so, go to safety.
Absolutely. And it's still, hang on, let me double check. So I saw the market a little bit ago.
It's 590 right now.
Let's go to the SPY real quick.
Yep.
Oh my gosh, hang on. I got to turn off replay. Yes. Okay. Which we will be doing the replay today. It should work. Hopefully. Should is a dirty word in trading. So we'll have to see if it works out actually. So, I mean, even to Dave's point, 1, 2, 3 closes under the 10 EMA. The 10 EMA, remember, that's the indicator of the short-term trend. That's telling you the direction that it's moving right now. Now, of course, we can't time Trump, right? Trump is a wild card in this market. You can see it popped right back up, but you can also see it popped right into this order block right here, which gives me a lot of hesitation. There's no way I'm buying anything when the market has overhead resistance that it just ran into. Now, we'll discuss order blocks later on, but right now, the market's it's not as strong as people want to claim it is, right? Yeah. When it's, in fact, let's do a little trend following lesson here. When the market's strong, it doesn't close under the 10 EMA. Look at this move right here. From, this was April 24th all the way until May 21st, an entire month of candles. Not once did it close under the 10 EMA, and it moved up beautifully. Then we had 3 in a row after that point, okay? So a market that is strong, that is happy, doesn't close under the 10 EMA. We just got 10. I don't know where it's going to go, and I'm not trying to predict. I'm just looking at the data that I have in front of me. So that leads us to lesson 5, and I have a question for you guys. Why does trend following work? And I'm actually going to fill this in on some things that you are telling me, right? So go ahead. Let's go one at a time. Let's go with Mike first. Tell me, why does trend following work?
You're not predicting. You're not trying to tell the future. You're actually reacting to what's happening in the market. So you'll see. You're not trying to push something and say this is going to happen. I think this will happen. You're watching it happen, and then you're reacting to what's happening.
Why is that important, Mike?
Otherwise, you're throwing money out there hoping something sticks.
Absolutely, for sure. All right, who's next? Joe, go ahead.
I'm reminded of the picture with the buyers and the sellers, and if everybody's yelling buy, trend's going up, right? So get onto the trend that you want to follow, the buy trend, right? Or if you're shorting, get on the sell trend. But either way, you don't want to be the one buyer in a sea full of sellers.
Yeah, because the market moves when there's more buyers, right? The more buyers that come to town pushes the market higher, which brings more buyers to town, which pushes the market higher, which brings more buyers to town, which pushes the market higher, right? It's a self-fulfilling prophecy. And at some point, it starts to turn, right? It starts to turn, and that self-fulfilling prophecy, I know I'm spelling that wrong. I don't care. That self-fulfilling prophecy will start turning around, and then the sellers will turn into more sellers, and that's why trend following works. Who else wants to go? Go ahead, Brad.
I was just reading the comments, and like Skinny Buff Guy said, riding the wave or the tide instead of actually swimming against it. That's perfect right there. And it's just math.
There you go.
It's just math.
It's just math. I tell you guys this all the time. It's just math, right? We can't fight it. We're not drawing. What do I like to say? Upside down triangle, cheesecake bull flag pennants, right? Like, I'm not a 6-year-old. I'm not drawing on my chart trying to say, oh, it has to do this at this point, elsewise the market's wrong. No, Just let the market tell you what it's going to do.
You might
So-
want to add a hyphen after that math and put it's not emotional.
It's not emotional. You're right. And so many traders are. And
Yeah.
that's what helps drive that fear and greed, right?
Yep.
It's not emotional where so many traders are, especially like today, where people are freaking out with the FOMO, for sure.
Yeah.
Go ahead, Ozzy Ian. We'll give Ozzy just a moment for the internet to catch up.
Just that something in the market's changed. We don't know what it is or what it will be, but the sentiment has changed. Something's changed.
That's right. That is the trend, right? Sentiment has changed. Well said. Okay, cool. So here are a couple things that I wanted to add to. I wanted to hear your guys' opinions first, and so thank you for that. Now here's a couple areas that I thought we could talk about. Right? Why does trend following work? Trend following is trading what's happening. Trading what's happening, not what might happen. I think somebody mentioned that over here. Not predicting, but reacting to the market. Well done. Forecasting. Right? That's not what we're doing here. That's guessing what's going to come next, which is impossible. We're looking for confirmation, not prediction, which is why confirmation is greater than prediction. It's significantly easier to wait for the trend than guessing the turning points. We'll actually be talking about trying to guess the turning points later. I have a fantastic example, and you're going to love it. Letting winners run helps your psychology, right? Focus on growing your gains and not fighting your losses. I've told you this before, and you've experienced it now in the last month or so. When you log into your account, it should be full of winners. That's normal for a winning trader. Let me repeat that. For those in the chat who didn't get a chance to trade with me, when you log into your account, it should be stacked with winners. The only things you should see in there are winners. And if there is a loser, it should be tiny. And it might even be on its way out that door the same day. When you trade correctly, you get so used to logging into your account and seeing win after win after win. And it's not like you're holding it for 28 years, right? Like some of these YouTubers are like, oh, I'm such a genius. I happened to buy this one stock that went up 2 years ago, and they're still holding on to it, right? In 2 years, you can turn over a lot. You can do some amazing work in your account to grow it, whereas he's still sitting on the one. So that is normal. That is what you're supposed to be doing. And trend following is listening to the market, not forcing the market to listen to you, not telling the market what it should be doing. Next, bullish versus bearish setups. Hey, how many of you guys, I know you're smart, but in the chat, type a number 2 if you didn't know you could make money when the market goes down. Now, probably everybody here has an understanding of that, but I would bet you 80, 90% of regular people have no idea. No idea. Wait a minute. I can profit as the market goes down. We'll talk about bearish setups later on, but that was a light bulb for me. I know I've told you guys this story, but when I was working in corporate finance, somebody was talking about buying puts on Deutsche Bank, and I was like, man, what is buying puts? Right? The price of the put goes up in value as the price of the stock goes down. So a put is inversely correlated with the price of a stock. And most people literally do not know how to short a stock. And that's okay, because I'm going to show you that later. Not today, but later on, I'll be showing you that. And so you got to look at this from both sides. Trends go up, trends go down. You can ride them up, catch the top, get some confirmation signals, and then you can ride it back down. It's actually pretty awesome. You don't have to force anything. Right? Yeah. Most people don't know how to do this. I'll teach you that later. But what is a bullish setup compared to a bearish setup? I want to hear from you gentlemen here. What is a bullish setup compared to a bearish setup? Go ahead, Deep Thought.
Because that'll be the opposite of the bullish will be a bearish. So it'll be 10 under the 20 and price under the 50.
You looked at the notes ahead of time, didn't you? Yeah, I trusted you. And here you go, making yourself look so intelligent. Exactly. Your 10 over the 20, price over the 50 is bullish. And your 10 under the 20, price under the 50 is bearish. Now, we will be doing a game in just a couple of minutes, and hopefully it works. And I want you guys to scream bullish or scream bearish, kind of like we did buy and sell last week, because we are trying to get used to that concept here, right? Now, chop. That's when moving averages are crossing back and forth and prices are stuck between moving average. Now, I'll tell you one area where a lot of people get frustrated. And this is when market breadth is going down, but the market trend is still pushing higher. Price is still pushing higher, but breadth is going down. That frustrates a lot of people. They don't understand that breadth is going down because they don't have the data that we're used to seeing. But they look at the market and they're like, oh man, what's going on, right? The market's just kind of drifting sideways to up a little bit. It's not having those forceful moves. The forceful high volatility moves are the ones where you're going to get paid. That's why we're lining up the breadth. That's why we're lining up the trend. That's why we line up everything together. The path of least resistance versus when I have an example that I'll share later on, but the breadth of the market will help push the market higher because more stocks getting buy signals, more buyers coming in, makes prices more expensive. When prices get more expensive, people get excited because they're like, hey, I want to own that stock that's getting more expensive, which causes more buyers to come in, which pushes breadth higher, which pushes the market higher, right? It's that cycle over and over and over. Now, we're going to play the game. We're going to play the replay game with bullish and bearish this time, okay? So I was looking at this earlier and I found a really good example, SMCI at the beginning of 2023. So hopefully this works out like I want. You know, last time we played this, it totally collapsed on me. But it looks like it could work. Beginning of 23 replay. Yes, it's working. Sweet. Okay, this is going to be awesome. So as we go, remember, we cannot see the future here. So we're not trying to predict the future. What I want you guys to do is to say bullish or bearish, right? Now, what would you say right here? So for context, the blue line is the 10 EMA. The black line is the 20 EMA. The red line is the 50 period EMA. At this very spot right here, what would that be? Bullish or bearish?
Sideways.
Let's say sideways, choppy.
It's chop.
I was trying to trick you guys with the trick question there. You're too smart for me. All right, cool. So we're going to run this, and I want you to yell out bullish or bearish as we go. Everybody ready? All right, here we go. 3, 2, 1, go.
Choppy.
It's just choppy.
Chop. Yeah. Bear.
Still choppy.
Oh my God.
That's
Oh,
bearish.
You knew I picked this one now, didn't you? That's who I picked this one.
Bear.
Cross the 50.
Way down.
Yeah, that's bearish.
Yeah.
That's
Bull.
bullish.
Right there's a bull
Still
right there.
bull.
Yeah,
Still
bullish.
bull.
Yeah, that's a bull.
Bull.
Hold on to it,
And
JC.
block.
Oh, man.
Chop.
Ooh,
God, order block.
Bullish.
bull.
Bull and
Oh.
free. All right.
Oh, hang tight. Hang tight. Ozzy Ian's trying to communicate by telegraph. Hang on. What does that say? I can't read.
Bullish.
There we go.
Oh,
He got it.
Excellent. Okay, I really appreciate that. That was good. Okay, back to this.
Ooh,
Yeah, still choppy, sideways.
yeah, that's chop.
Bullish. Bullish.
Bullish.
bullish.
Hold tight. I got to move off the screen right there. That's how bullish it got. Here we go.
Oh,
Still bullish.
Now remember, we're just doing 10 over 20,
Bullish.
price over 50 in this case here, right? So even when it pulls back like this, right, your 10 is still over the 20, price is still over the 50. This is a hard time. This is where people freak out because they're like, no, I can't. It's not working. And then the very next day, still a bullish trend. The very next day, a beautiful big green candle, rocket ships even higher, right?
Yep.
So continue to
Okay.
think about 10 over 20, price over 50.
But wouldn't we have closed because we closed under the
Well-
10 EMA?
Possibly, but that's not the exercise we're working on here.
Oh, okay.
We're just working on bullish trends versus bearish trends here.
Yeah, still
Gotcha.
bullish.
yeah, it's very bullish.
Still bullish.
Yeah, here's another example here, right? A big, ugly close down didn't break the trend, right? So you can still enter on a candle right here because the trend's not broken.
Still bullish.
Now, here's an example of an order block.
Here we go.
Look at this order block, rejecting multiple times.
Yeah, that's bearish.
Bearish.
Now that's
Very
bearish.
strong. Yeah.
Yeah. Oh, wait a minute.
Bullish again. Almost bullish.
Tricked you.
Bang!
There we go. Golly, man,
Dang.
that's awesome.
Right through.
Right through the
Still
outlier
bullish.
block.
Bullish.
Bull.
That was earnings.
Go.
Yeah.
There's
That's
another
good
one.
earnings.
It's a gap and go.
That is a gap and
Oh,
go.
great example. Well said, Deep Thought.
Yeah.
A gap and go. Exactly. A big move up after earnings and didn't even come
Bang,
close to coming back down here. Gap up and run. That's exactly a gap and go. Oh,
Woo,
even
wow.
higher.
Another gap and go.
Other gap. Yeah.
Still
Why is
bullish.
there another? Oh, got it.
Bull.
Bull, bull,
Bull.
bull.
Bull. Still.
Growing horns.
Still bull.
Still
Still
bullish.
bullish. Still bull.
Still.
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 Still
Still.
bullish.
Damn.
Going through the outlier block.
Still bullish. Man, I should
Yep.
be rich. I should be rich.
Bullish.
It's the most
That's
dangerous
bullish.
word in finance, Mike. That's why so many people go broke, actually. I should be rich by now. What did I do wrong?
Man, that's beautiful.
Good run, man. Good run.
And look,
Bull.
every once in a while, it'll catch up to itself, right? And it might come down a little bit, but that bullish trend continues. If this is a big, beautiful, strong bullish trend, it will just punish anybody who tries to go against it. And we'll talk about counter trend trading in a little bit. It'll punish you as it continues to push higher and higher and higher. But look at this, right? When it's in a beautiful trend, it doesn't close under that 10 EMA. Does not. Now, there are some pullbacks here and there, but it still will push higher and higher and higher. Like, look at this. It came from right here at $13 all the way up to 23. So almost double before it closed under that 10 EMA. This is what we got to look for as traders. Those big opportunities, this volatility that we talked about.
Watch out for earnings.
Okay, yeah.
Bull.
It's still bullish.
Bearish.
There it is. There's the bear.
Now, that's a bearish trend, that crossover right there. But remember, this was a big bullish move after earnings, and a lot of people figured, oh my gosh, all the people on YouTube are screaming about how smart it will be to buy this stock after earnings because look what it did after the last earnings. And then, hold tight. This doesn't look good. Let's see what happens next.
That was a lot of volume too.
That's a bear. Oh.
Yeah.
Almost. Still chop.
Uh,
Here we go. Bullish.
No.
Bearish again. No. Sideways.
Now, here's another outlier block that it's bouncing off of. Watch for that.
Yeah. Bearish.
Yeah,
Bear.
now it's a bear.
bear.
I mean, now everything's under the 50.
And going bullish again.
That's
Yep.
good.
Right there. Oh,
And bearish.
bearish.
Yeah.
Very bearish.
Very bearish.
Yeah. I think it's
If
getting
it gets any
tired.
support, it got some support.
Yeah, you would think that would.
See
It
it
should.
bouncing off that block.
It
Yeah.
should.
Oh, no.
Should.
No. That's a dollar in the swear jar.
That's
Oh, hang on.
sarcasm.
Here's another earnings report right here, right? So
Yeah.
big move up after earnings, big move down after earnings, then really went sideways after that point. So there was a lot of chop right here, and then another earnings, and nothing happened. Right? It didn't do anything. So
How do you know
earnings
it's
are
an
such a
earning?
this line right here and this
Got
little
it.
E.
Got it.
So I wanted to show you guys this, and we could continue to do this for a long time. But the point being is that we can't see the future. even a bullish trend has an ending point, but we have to be aware of what the market is telling us, right? I mean, if you decide to start shorting right here, you're going to lose your pants, right? It's just not going to work. It's just going to go and go and go and take you out. Or if you wanted to go long right here, right? And then it turns around, goes the other way, and it might take you a full month to get back to break even. It's all about listening to the market and letting the market tell you which direction it's going to go. So I'm glad that one worked out today. Couple things to notice here. Notice the width between the moving averages when you have a big, strong trend, right? Look at this big, strong trend right here. See the distance between the 10 and the 20 and the 50? Right, they're miles apart, right? You could fit the state of Texas right here. And then you go over here and they're squished together. Maybe a light bulb moment right there, because what happened? There was a lot of choppiness, lots of choppiness right here. But this was a big, beautiful, strong trend that you could ride for ages and ages and ages, right? The width of the moving averages is what you want to see. You want to see them spread apart because that tells you the moving averages are strong. Prices are moving, right? But when they condense and collapse back together, that's some choppy areas right there. Pretty cool, huh?
Hey,
So
Chris.
notice when they spread apart, the trend is strong. And when they're close, the trend gets weaker. Go ahead, Brad.
So I've heard you say before, just watch how wide the lines get, the 10 and the 20 get, because it can snap back pretty quickly the wider they get. Is that a concern when you're watching trends go up?
I put more emphasis on the fear and greed for that sort of snapback. But it can happen, right? It totally can. What you need to keep in mind is where you are planning to get out for risk. So let's look at a couple examples right here. Risk-wise, if I'm using the 10 EMA as my trailing stop, and remember we talked about earlier, a trailing stop follows you as you go. So if I got in at the close to the trailing stop here, it's about 7%. It's quite a bit. But the very next day, if I wanted to enter, it's 20.85%. The very next day. That is a high-risk trade to me. This is a low-risk trade to me. Do we see the difference here? Because you want to get in as close to your stop as you possibly can. And if it works, awesome. But notice, between those two dates, let me remove my drawings here. Between these two dates, the moving average is moving up, but the price has moved up so much that this is a much higher risk trade to enter here than to enter right here. But the spread of them is still not really all that different between day one and day two. Does that make sense? Okay, cool.
Okay.
A weak trend can turn into a strong trend at any point. Okay. So going back to over here, a weak trend can turn into a strong trend at any point. We don't know. We don't know if this crossover right here is going to look like this 100% move. But the difference in somebody who's risk first and somebody who just hopes and prays is that if it doesn't work and it turns around, we'll get out. No big deal. The other person will sit there for months hoping and praying that they can just get back to break even. Right? Big difference there in the mindset. The goal is to be there when the trend starts, but we can't predict the outcome. We can only control our processes, right? So if you got in on this crossover here, and then you got out on this crossover here, you might have made a buck or lost a buck, but that's okay. Kept your risk tight. If you got in over here, you might have made a whole heap and helping full of bucks. We can't control what happens, but both of these had a 10 over 20 price over 50 crossover because it's just math. All right, next slide. Chop. You might make a buck or lose a buck, right? You've heard me say that a million times, and it's true, right? We don't know when the trend is going to explode, but we have to make sure that we're ready for when it does. You will never, ever, ever make big gains unless you're in the trend. I don't know how these YouTubers or other people on the internet who have no idea how to trade, who talk about trading, which blows my mind, but they find a stock, I don't know, maybe like AMD, and they're like, let's turn off replay here. Yes. Right. The stock like AMD, and they're like, oh my God, it's such an amazing buying opportunity. And it just goes down and down and down and down and down and down. And finally, months later, catches a bottom and starts to come back up. You don't have to do that. Right? You can make a buck or lose a buck, but if you pray and hold that something comes back, you're just going to be losing all day, every day. So what I'm going to say here is that you're not going to make the big gains unless you're in the trend, right? You're not making a gain right here as the trend is going down. But then we can swap over to like hymns, right? You are going to make all kinds of money because you're in the trend as it's going up, right? If you're buying something, we want the price to go up. So watching it just evaporate like this because you think you know better is so dumb to me. It is so dumb. Chop happens, EMAs are flat or converging, and price doesn't have a clear direction. Now, if there's no clear direction, you have no edge, means sit in cash and don't F up, right? Sit in cash and don't F up because you don't have all the momentum behind you. You've got to have that momentum to push it forward. Now let's talk about counter trend trading. This is absolutely the fastest way to blow out your account. This is what I did blowing out my account, right? When you see a stock that's going up and you say, it can't go up any further, I have to buy it. Or I have to sell it from here. No, it can't go up any further. Or when you see a stock that's been going down and you say, it has to go up from here, it cannot possibly go lower from here, you have to buy it. That is counter trend trading. And that is the fastest way to blow up your account. And I've done it twice, okay? You will never, ever, from this moment forward, for you guys watching live, for you watching the replay, for everybody in the chat right now, you are never allowed to counter trend trade. No, Chris has forbidden this, right? If you can take one thing away from all of Outlier University, don't counter trend trade, okay? You will never catch the top. Sorry, not going to happen. You will never catch the bottom. Just not going to happen. So stop trying to tell the market where it will turn, right? Stop trying to say every little bounce is the bottom. Here we go to the moon, Lambos by the end of the day. You don't have to trade like that.
You did call the bottom a couple of weeks ago.
Well, I may have had Outlier 9 working in my favor. Who knows? But everybody else watching in the chat, you will never be allowed to counter trend trade. And I didn't trade until the trends worked with me, by the way. But listen, you will be the hero of your story by catching the 80% in the middle, right? We talked about the brisket sandwich. You're going to be the hero. You will make so much money catching the middle. You're not going to catch the bottom. Just be okay with that. But you can make good gravy loads of money by catching the 80% in the middle. And you only can do that after the trend changes direction. So let's go to AMD, right? You will not be profitable all the way down, but you can be profitable when it starts moving up and you're there buying it as it starts to move up. Now, always keep in mind, we do not know when the trend will change. Because we don't know that, we can't say that this will go up forever. We can't attach price targets. We can't get emotionally involved with any stock because all stocks are bad. All stocks are bad. But every once in a while they act right. So I want to show you an example of somebody who counter trend traded and lost their shit. This is an account that I used to follow many years ago. I don't follow anybody on Twitter anymore. I literally do not look at Twitter, and I will not call it X. It's Twitter. That's stupid. Looking at this person that I used to follow, I don't anymore, and I blacked out his name. He says, I have entered an ungodly big short position on the Qs for one and only one reason, right? It's going up. An ungodly short big position on the Qs. That was on this candle right here. I wonder what happened after that. I wonder if he had any money left over at that point. Because he would get monkey hammered to death trying to hold a short position as it's just screaming higher, right? Surely he was able to get out with maybe a couple bucks right here. But if he continued to hold it thinking he was so smart that the market has to go down from here, it should go up or it should never, ever, ever be this high. Look at it now. Just look at it now. Now, this is a quote from Larry Hite, one of my mentors, very first $1 billion hedge fund manager. And he says, I have two basic rules in winning and in life. If you don't bet, you can't win, right? So you have to find an edge And then you have to actually take the bet. You have to see if it works. Here's the deal. If you lose all your chips, you can't bet. Meaning, if you lose all your money shorting the NASDAQ, you have no more money left to bet. So you can't make that back. It is gone forever. So that's the quote he hangs his hat on. Here's the deal. I always say you could publish the rules in a newspaper and nobody would follow them. The key is consistency and discipline, right? And we're giving AlphaU away for free. And so many people it will go one in one ear and out the other. And if you're listening to this, I am giving you professional, expert, 7-figure trading advice right now. And you're probably not even going to listen. You're probably going to forget about it, just like you forgot about everything else. And you're going to go back to your old ways. I can't help you with that. And then you're going to leave a YouTube comment saying how much money Chris lost you. But this is how it's done. This is how it's done. Let me delete that slide. Trends. I've spent so much time on trend following with you guys because it works. Okay. You guys hopefully don't have to unlearn all the bad habits that I had learned. But by now, you should understand that trend following works because it's just math. You cannot make the big money unless you're in the trend because profits follow price. Now let's focus over on outlier signals. We're going to move over to outlier signals. So we're going to change gears here. Don't take any signals. Do not take buy signals without confluence from other sources. And I like to use the outlier 9 to be on the right side of all the trends working together. Now, what I have highlighted here, or circled, I should say, every single one of these follows a trend. The trend of the market follows a trend. The trend of the breadth follows a trend. The trend of the fear and greed follows a trend. The breadth again, the trend of the stock, the fear and greed. All of this is following trends. 5 of the 9 itty bitty baby steps involve following trends. That's why I've spent so much time working on this with you. Now let's talk about breadth. So I want to ask you before I have one perfect example. I feel it's perfect. It's tremendous. It's the best example of all time. If Joe Biden had this example, he would have made so much money, but no, he was stupid. He let China run all over him. The breadth. Tell me what breadth means to you guys. And you can do your best Trump impression if you choose to. You don't have to. But what does breadth mean to you? So I'm gonna open it to you guys. What does breadth mean to you? By the way, Dan wants everyone to know that he hates bad breath. And I agree. I also hate bad breath. All right, who's first? Raise your hand if you're going to go first. Go ahead, Dave.
I'll jump in. To me, the market breadth is the sentiment. It is telling us where the market really is going before the market actually reacts. It's saying we got a bad feeling or we got a great feeling. Doesn't matter, but it's that, I don't want to say quite predictive, but it's, and I've said this in the chats, it's reading the tea leaves. It's seeing that we have movement that's happening that may not be reflected yet in the SPY, but is being reflected in the small caps. It is being reflected in those mid caps. It just isn't up to the S&P 500 quite yet, but it's giving us those warning signals. So to me, it's a sentiment indicator.
Nice. Very good. Who wants to go next? Go ahead, Joe.
It's the number of stocks with a buy signal versus the number of stocks with a sell signal.
No,
So
I get that. But what does it mean?
It gives us an indication of people are interested in buying it. They're interested in buying more stocks. If you look at the market as a whole and you have more stocks with buy signals, that means it's trending upward. People are willing to put their money on the line and don't have such fear of risking it as the inverse would suggest.
Very good. Excellent. Yeah. We'll discuss what the textbook breadth definition here is in a minute, but I'm trying to get an idea of what does it mean to you? Like a trend to me means, hey, there's something happening and I want to be on board, right? But it can also mean 10 over 20, price over 50. All right, who's next?
I'll go.
Go ahead, Brad.
To me, it's one of the foundations. You know, it's one of those first pieces that you look at in order to then move to the next pieces, and it helps save time, because if your breadth is working against you, I mean, it's hard to it's hard to get on that slingshot if breadth isn't there. So that's how I use it and look at it.
Yeah, that makes sense. Deep Thought, I think you raised your hand.
Yeah, there was two guys in the chat actually. Nate was one of them. Said breadth is the measure of the market cycle, and then right below him, Nico said breadth is the market tide, and both of those are really, really good explanations.
Yes, absolutely. Perfect. And thank you guys for commenting in the chat. JC, go ahead.
Since I'm the newbie here, it's like, isn't it like what the stocks are doing? Whether the market is the market trend, whether it's bullish or bearish, what most stocks are doing in a very general sense. Does that make sense?
I'm glad you asked that question. So let's talk about what breadth actually is, like the textbook definition of it, right? So for us, the way that we measure in Outlier is the number of stocks with buy signals versus sell signals. So for example, a breadth of 100 means that every single stock has a buy signal. A breadth of 50 means only half of them have buy signals. Okay, so now what we want to do is we want to have the trend of the stock moving in our favor, but we also want to have the trend of the breadth moving in our favor, meaning more stocks getting buy signals versus sell signals. So circled in green right here is when breadth is growing, meaning more stocks are getting buy signals, which is going to push the market up higher. And then over here is more stocks getting sell signals, which is going to push the market lower. Okay, so we combine the trend of the market plus the market breadth to get to this point, because more stocks getting buy signals means more buyers are coming in, which is going to push the trend up higher of the stock. And then the trend being pushed up higher is going to push up breadth because the people are excited and so they want to buy because the prices are going up. So it's that virtuous cycle or vicious cycle, depending on your direction that you want to look at. Next, let's talk about fear and greed. So this is a high-level view of fear and greed. You can actually find this on the Outlier website here. But to get the fear and greed calculations, what we do is we have data that gets ingested, where it's investors reacting to changing market conditions, latest news, and other economic measurements. And then proprietary methods collect the investor reactions at the individual stock level. Then the algorithmic identification of investor buy. You can tell this is written by Mark because he loves big words. But algorithmic identification of investor biases. And then the Outlier identifies periods of extreme irrationality for individual assets, which then leads to the fear and greed heat map right here, okay? Outlier models distinguish behaviors from baseline rationality and displays these differences as excessive fear or greed. Now, to put those in simple terms, because I told Mark this is far too high level, I don't even get it, right? Outlier monitors if investors are acting irrationally fearful, or wait, I got ahead of myself. One slide too fast. Outlier monitors how investors are reacting to changing market conditions, news, price movements, and the economy. Okay, this is not just the price of the stock. This is a complete how are people feeling about the stock, about the market, about the sector altogether. Then Outlier determines if investors are acting irrationally fearful or greedy, and by how much. Right, we assign that score. And then it gives those buy and sell signals when those irrational behaviors reach an extreme and likely to reverse, right? If all the sellers have come in and everybody's scared to death, but then they stop coming in, what's going to happen? Those sellers are going to turn around and start turning into buyers, right? And when all the buyers have come in and all the buyers are starting to slow down, those buyers will eventually turn into sellers because it's reached an extreme and starts to turn around. That's what we're measuring here. And it goes beyond price, right? This is a lot of data that's just beyond price. Now, of course, it allows you to get into the stock before the outlier move happens. So I want to show a couple examples of fear and greed. When fear gets really high or greed gets really high, watch for snapbacks. So this is United Healthcare. Really interesting stock because it got ultra fearful and then it started to push up. And we'll look at the outlier data in just a minute. But it got really fearful and then buy signals came through and then it started to push higher and higher and higher. And then it got really greedy, right? It went from very fearful to very greedy in a short period of time and the price went up accordingly. Then it peaked in fear, sell signal, and it went into peaked in greed, sell signal, and then it went to ultra fear category over here. So let's go into UNH real quick. Give me just a moment here. I thought it was locked in. 2 seconds. Okay. So let's go to UNH. And the fear and greed measures from 0 to 100. Okay. If it's at 0, nobody is greedy. That's a scary time. If it's at 100, everybody and their mom is greedy. Okay. So here's that same chart that we were looking at just a moment ago. It got super fearful down at 17, and then it ran up and up and up and up and up and up, and it peaked right here at 87. And then it had a huge snapback and went all the way down to 2 out of 100. So this is exceptionally fearful. And so we can look at any stock, right? We can look at HIMS, which I know is going to have a huge move up and then a huge move back down right here. Right. And just when people got ultra fearful, what happened? It ran up. Okay. Just when people got ultra greedy, what happened? It pulled back. And then right here, you can see the ultra greediness, and then it pulled back. So we're measuring how fearful and how greedy the investors are. And that gives you a leg up in the market that nobody else has, right? To be able to see the stock, to be able to see the sector, right? To be able to see the market. This is data that people wish they had, and they can get it for just 82 cents a day. I'm just saying, over outlier.com, only 82 cents a day. But looking at this, right? There are times where they split, but also times where they work together. Like, so HIMS right here, it's getting more and more greedy. It's got a bullish trend. It's got a buy signal. The sector is getting less fearful while the stock is getting more greedy. That's the combination you want. The sector is getting more greedy. The stock is getting more greedy. The stock has a buy signal. The stock is in a uptrend. And then what happens? Lambos, right? And then on the other end, people get so greedy. The sector doesn't really cooperate here for this example, but imagine that the sector starts going down. The price starts coming down. The fear starts getting more and more and more. What happens? Food stamps, right? We go from one end to the other. And a lot of people trade like that, right? A lot of people say it's either Lambos or food stamps. It's all or nothing. And you don't have to be that way. You don't have to do that. But we're measuring the fear. We're measuring the greed. And that's what we're looking for here are those snapbacks. The greedier or more fearful people get, the more likely there is to be a sharp snapback. You want to enter as people are getting more greedy, right? They're rushing into the market, and get out before the greed peaks and snaps back as people rush to the exit. So consider it like this. We want to be in as the price is moving up, as people are getting more greedy, but get out before they start rushing for the exits. A lot of people round trip stocks time after time after time, like Tesla, right? The 120% up move, followed by the entire 100% of that move right back down. A lot of people round trip that because they had no idea where to get out. But if we go in Outlier, and I'm not cherry picking this because I don't know the data here, but I'm pretty sure it's going to support my thesis. If we look in Outlier, look at that. People got fearful, and then it spiked up. It got really greedy, pull back in a little bit on greed, and then another run up on greed. And then it's getting less greedy, less greedy, less greedy. Now, keep in mind, the price went sideways for about 3 months, but you can see how much less greedy people were getting. And then it fell down, right? And then it got ultra fearful, and then its prices are starting to come back up. Right? So this is the kind of stuff that we're looking for when we get into a stock. We want to make sure that the fear and greed is growing because that's more and more people getting excited about owning the same stock that you want to own, which is going to push the price higher. Imagine it's a bidding war, right? Imagine you are trying to buy a house. Imagine you want to move to beautiful Lake Jackson, Texas. And there's this house out on the lake. And people are just like, man, I want to get in Lake Jackson like no one's business. So people are fighting to buy that house, right? That $200,000 house turns into a $400,000 house, turns into $1 million house because people want to be in. The greed for that incredible bass fishing on Lake Jackson. I have no idea. I'm just making this up. That incredible bass fishing on Lake Jackson is so amazing. People are losing their minds over it. But then They close the Texas Roadhouse in Lake Jackson. And people are like, no, not the Texas Roadhouse. That was supporting our entire economy. Then they close an elementary school because more and more people are moving out. And then the prices start crashing back down, right? People get fearful. Hey, if I don't sell my house today, then I may not have $1 million. And this house I bought for 200,000 when everybody was getting more greedy. Now it's at $1 million. I better get out while I can because I'm scared I'm gonna lose money. Same thing as stocks, right? Because it's assets. They may be different types of assets, but they still perform the same way with the fear and with the greed. Does that make sense to you guys? Cool. All right, final slide of the day. Outlier signals, right? Fear and greed lead to buy signals. Buy signals drive the market and sector breadth. Breadth drives the trend of the market because more and more people are buying. And then the fear and greed goes up. And then the buy signals drive market breadth. And then people with the buy and sell signals coming through, right? It's a cycle right here. None of this happens in isolation. And that's why when you look for setups, you want to be looking over here, right? Remember, 40% is due to the market, 30% is due to the sector, and only 30% is due to the stock itself. When you put all that together, that's your slingshot. That's what makes it easy to successfully trade in the market. Easy to successfully trade in the market. And like I say, that's when you get into a trade and it just feels effortless. You buy a stock and you're like, wow, this is how it's supposed to be done. That's when you log into your account and you're just full of winners. Oh, that's how trading's supposed to be done. Okay, now I understand what Chris is talking about. And when this doesn't light up, your job is to sit in cash and not F up. That sitting in cash and not effing up is really hard when there's FOMO, right? When you've got money in your account, got all these dollars in your account that aren't doing anything. How can I not be making money right now? That is what you need to be doing. Following your plan, not stressing. So I wanted to talk about the breadth. I want to talk about the signals. I want to start piecing these things together because we're going to get more and more complicated, if you want to think of it that way, as these lessons go on. So in the chat, go ahead and start asking questions, and do me a favor, try to keep them on topic for this lesson. But for you guys here in class, how can I help you? What questions do you have that I can help you with? Go ahead, Joe.
Slide 21, the example of the trader who shorted counter trend trading. Could that person have bought a put and simply just lost the value of his contract?
That's a great question, right? So imagine he bought all the puts that he wanted, right? Let's say he bought $10,000 worth of puts. If the market went up, the most he could possibly lose is $10,000. Absolutely right. However, let's say that he went short stocks. Let's say he sold stocks short. By doing so, he has unlimited losses. So it could just go on and on and on. Or, heaven forbid, he sold calls against it. If he sold calls against it, he's now got leveraged losing his shorts. Like, that's how bad it's going to get. It's not just losing his shorts. He's got leverage losing his shorts, and it's going to really blow. So, yeah. I mean, please, guys, please do not ever sell options. But to that point, yeah, if he had bought puts, he would lose the most of, I mean, we can rank this in like how bad in severity it would be. Buying puts, least severe, because he's capped his risk. Selling stock short, more severe, because that has unlimited losses against him, unlimited loss potential against him. Selling calls has unlimited losses plus leverage. So that's the progression of how much worse could this get. What else you guys got? No questions from the students? Okay. I really like this style, or we can I can ask you guys questions and you work on giving me the answers. I think that makes it more interesting. So I appreciate y'all's feedback today. Joe,
I see a good one. I see a good one in the chat from Patrick. He's saying, why would you sell a call over buying a put just for the premium?
Why would you sell a call over buying a put just for the premium? Okay, so we will be getting into lots of options theory later on. But when you sell a call, the price actually can go up to your strike price. So, oh man, you're going to make me do it, aren't you, Joe? Going to make me get nerdy. I trusted you. Hang on.
I was thinking it. Patrick just wrote it down.
Selling calls versus buying puts. I'm hoping that there's a good image of this. We can try this one. Open image in new tab. Zoom it in. Okay. So this is a long put. This is if you're buying a put. This is a short call. This is if you're selling the call. So let's take a screenshot of this because I'm going to draw all over it. Okay. So a short call and a long put. Don't worry about this. And don't worry about this. Okay. Both of these are bearish trades, right? This is one I'm likely to put on. This is one you couldn't force me to do this even if you pulled every tooth out of my head one by one with rusty pliers. Okay. Not going to happen. That's how much I am so vehemently against selling calls. Short means you sold it. Long means you bought it. So in a short call example, you have unlimited losses. Okay. As the stock price moves up, a la this example, as the stock price moves up, you have unlimited losses. They put, as the stock price goes up, the most you can lose is what you paid for it. Now, the break-even price would be actually far away. Let's say that this is the current price. Let's say the current price is 100, and they sold the 105 strike calls. Right. This is way beyond the scope of this lesson, but we're going to do it anyway. Let's say the current price is right here, and this is 100. Part of it is that as an option seller, we need time to pass. We need time to pass. Ugh. Whereas this one here, we don't want time to pass. We want our move to happen with as little time as possible. Because at expiration is if it's anywhere between 105 and 0, okay, on the short call, anywhere from 105 or less, this will be profitable. Which, starting at 100, going up to 105 means it can go up, it can go down, or it can go nowhere, and you're still profitable. That is the sexy part of option selling. That is what people get suckered into. I was that person, by the way. That is what people want so bad. Oh, I want the easiest trade ever. It can go up, it can go down, it can go sideways, and I'm still profitable. Easy. The insidious nature. So let's define insidious here real quick. Okay, I would definitely not talk about that, but proceeding in a gradual, subtle way with harmful effects. Okay, proceeding in a gradual and subtle way with harmful effects. Now, why do I call selling options insidious? Because you have to have time pass. You will not get paid unless time passes. So if you sold the option that takes 21 days to expire, you only get paid the premium you sold it for. Maybe you sold it for $1 and I bought it from you for $1. Okay. I bought it for $1. You sold it for $1. You will not get paid that $1 until the very last day. You have to wait day after day after day after, and this is the insidious part. Small harmful effects day after day. Day after day after day after day. Hoping and praying that it works. Whereas I'm going to spend $1. I'll know in a couple days if it's going to work or not. And if it doesn't, I might sell it back. I might get rid of it for 90 cents on the dollar. That's okay. Fine with me. But if the price plummets, I could make 100 times 100, 10,000. Right? I could make 10,000. If the price plummets here, the most you can make is that $1. You are limited to that $1. No matter what, it can go from 105 down to 0, and the very most you can make is $1. Whereas the very most I can make is $100 per share as it crashes. $1 per share total, period. Not getting more than that. Versus I could make 100 times what you're making here. And my risk was exceptionally small. And I was able to get in and get out without having to wait for my profits to tick by day after day after day. Hugely different. Tremendously different. They accomplish the same thing, which is a bearish trade in both sides. But one of them does it with leverage that helps you. One of them does it with leverage that works against you. So I told you I would nerd out, dude. But options trading is coming later. Okay, don't get and actually that's one of the reasons why I'm doing the Wednesday morning live streams where we do option deep dives, is so then I can tell you guys to go watch that whole series. It'll be easier on me that way. But that's one of the reasons I'm doing that. So yeah, there you go. Great question here. Any other questions from the gentlemen in the class? Deep Thought looks like I blew his mind.
No, you didn't.
Okay, good. Mikey Mike, what's up?
Not so much a question. I noticed in the Discord a lot, and you've said it a lot, heard it a lot, but the psychology of man, that has got to be the biggest thing in all. The biggest thing. I mean, people are wigging out or panicking or, God, I feel guilty. I'm not doing this. I mean, there's more comments like that than, hey, I bought, Dollar General for the. I mean, we get plenty of those too, but I can't believe how much the mental, like they have to undo. Like if somebody's been trading for 10 years or listening and trying to undo this versus, like me, I'm just learning. So I haven't got the bad habits to undo, but I can't believe the amount of psychology involved in trading. I think that's the biggest thing, is getting past your own self and trying to lock onto, like you said, a plan. It doesn't have to be your plan, but if it's worth planning and and you ignore it, why'd you do it? So I just that's something that really sticks in my head. I just see so much of that in the Discord.
FOMO's real, right? And we as successful traders, right? The 90% of people lose 90% of their accounts the first 90 days of trading because they do the same thing over and over and over, right? Because it's psychology of people who come in the market. We have to work against it. We have to do the opposite, right? Everybody freaking out. We have to do the opposite, exactly the opposite, right? Because we are the successful 10%. Really, honestly, the successful 2%, maybe even less. And the only way we do that is by doing the opposite of what everybody else does. And it's hard. It's super hard. Yeah, for sure. What else you guys got?
I see it as an addiction, to tell you the truth. Almost like not an addiction, but an addictive quality to it. It's like they got to do something. They got to do something. They got to do something. It's like, no, you don't have to do anything. Go play racquetball, ride a bike, do something. You don't have to sit in front of the screen and make something happen. It's going to happen. It's going to tell you it's happening. Then when it tells you it's happening, then act. I mean, since I'm like some of you guys that have no habits, because I don't know anything, and I'm thankful because I don't have to sit in front of my computer. I don't want to sit in front of my computer. I don't want to look at candles on a minute by minute. No, I like the end of day is fine by me. 2 or 3 times a week is fine by me, and then go out and enjoy life, man. Mm-hmm. But I'm telling you, I'm a part of a little group, which I love. Very nice guys. We call it the Brotherhood. But bro, it's like, bam, they're IV'd in. And if it's not happening every day, it's like they're missing something.
Yeah.
Yeah. I would agree. I think what we see a lot in the chat is, quite frankly, I'll call it gambling addictions.
Yeah.
I think we do see a lot of that in here. And, people are looking in Discord for validation for their excuses to put their accounts at risk and blow them. And you're not going to get a validation out of me on that. I'm all for making money. Trust me, I love the high when we make big money. I really do. But I'm also fine to sit back on days like this and say, you know what? It's just, I'm not feeling it. The indicators aren't there. The market is not giving me direction. There's too many variables. And, it's important to be able to walk away. I think it's important, get off the Discord on the weekends, quit trying to think about what you're going to do Monday morning on Saturday, get out and enjoy life and go barbecue and smoke some brisket or throw some tri-tip on the grill and, be with family. There's a time to turn it on and a time to turn it off.
I also like how David calls people out in the Discord on that kind of stuff too. I mean, he set a few people straight. I mean, and not rude, but I appreciate that too. So
but that's also really important to do, right? I've shared with you my stories of being basically bitch slapped by people I highly recommended, highly respected. I'm like, shut up. I'll never forget when Mark Minervini told me to shut up and listen instead of telling him what I do. He didn't care. He doesn't care. Why would he care? Why would he want to know all the stuff I do wrong? How about you shut up and listen to somebody who's actually making money in the markets instead of trying to impart your incredible wisdom of how to lose money onto me?
Exactly.
I mean, basically, that's what's happening. And it's tough love, right? It doesn't get YouTube clicks, right? It doesn't make people happy for one of their trading heroes to be brutally honest with you. And I get it. And it's not meant to be offensive. It's not meant to hurt feelings. It's meant to basically open your eyes to, you don't have to do that. I'm showing you everything you need to know. So you need to start listening. But yeah, I definitely think that there's definitely a gambling aspect to it, for sure. I think a lot of people get into it just because they feel it's a casino they can access 5 days a week from their phone. So yeah,
that's not a casino. It has some validity to it in their minds.
For sure. All right. Let's do some questions from the chat here. If you guys see any in particular, do me a favor and call them out. But I'm going to try and go through and see if I can pop up any that do good. Like Mitch has a question here. I don't understand why some people would directly short stocks versus puts simply from the risk factor. Exactly what I talked about earlier, right? Unlimited risk to the upside versus buying puts, limiting your risk plus leverage in your favor. I don't know why either. But some people, I don't know. I just don't know. It may be a volume aspect because I know like Bill Ackman, if you guys know Bill Ackman, he's an activist investor, and he likes to find stocks to just short the mess out of. And I don't think that there's enough puts in the world to satisfy what he needs. So he'll go in and buy like, millions and millions of shares of stock, or sell millions and millions of shares of stock short, but then not get out when it works against them. Like there's some really brutal stories of people who think that they're geniuses because they managed tons of money, losing ungodly amounts of money because they couldn't bring themselves to just admit they were wrong. Like, it doesn't matter how much money you have, you can still be wrong. That's okay. Albert says, my favorite question is, I understand why Chris says never counter trend, but isn't it just a matter of finding a back-tested data set where outlier data tells us? So I'll assume his question here is, hey, you know what? Don't counter trend trade unless you have the data. And dude, go for it. That's why I always tell you guys all the time, find a style that works for you and do that. Okay? I know what works for me. I know the easiest way. I can tell you all kinds of ways to lose money, but figure out what works for you and just go with that.
Hey,
Brad,
Chris. David M was asking, can you talk about your weeks out at 80 delta you prefer? Like 3 weeks out? Or
yes.
I'm thinking it's probably about the options that you're
for sure
setting up.
So David M, first off, great avatar. Welcome to Texas. I'm glad you're here, my friend. Second off, the 3 weeks out is really just it's handy for me because it gives me some flexibility. I don't have to be right today on a 0 DTE option. That's so scary to me. I can have multiple days to find out if the trade is going to work. I like 3 weeks out because that's generally how long my trades are in general or less. So sometimes I'll go 4 weeks, sometimes I'll go 6, sometimes I'll go 2, but that gives me a starting point, right? 21 days, and then I'll start working back and forth for liquidity. Nothing hard and fast, but if it gets within a week of expiration, I'm rolling out, so I don't have expiration risk working against me. But if it goes too far out in the future, then I have to pay extra for the extrinsic value. And if I have to pay extra for extrinsic value, then I can't buy as many contracts. So it's a balance here. And for me, that's where I found my sweet spot. Doesn't have to be that for you, my friend. Figure out what works for you and go for that. Now, the 80 delta, that is where I have found a really good sweet spot where you're paying the least amount of extrinsic value without having to pay so much for the option in total. Meaning the further you go, it's diminishing returns. So like the 90, the 95, 98, that's going to get more and more and more and more and more expensive with diminishing returns on your delta. Delta meaning the change in price of the option for every $1 change in underlying stock. So if I have to go from the 80 delta to the 90 delta, and it costs me $2 more, I may not make up that $2 ever in the price of the option. So that's why I say it's diminishing returns after that point. Of course, I'll go a little bit more, a little bit less based on liquidity, but that's just a good starting point there. All right, let's see. RT Liner says, deep down, everyone wants to buy Microsoft in 1986 and hold, right? Isn't that the ending of the Hot Tub Time Machine, where he goes and tells them to go buy Google in the 80s, and then he comes out on the other end and he's, you know, a trillionaire? Or Back to the Future. Man, instead of that stupid sports almanac, imagine if you had the stock charts from like 2015 all the way back to 1955. Bro, that would be ungodly. I would be all about that. Is there a good meme coin to invest in? That's up to you. Figure out your plan, because you ain't getting that from me. Hey, you know what? Albertone says Dave tries to educate us on Discord. So well done, Dave. What's up, Joe?
Speaking of the breast slide that you went over, have you seen where there's a typical number of days or weeks where a trend will turn around? Have you seen any sort of patterns like that, or you just wait till it happens?
It's really wait till it happens, right? In fact, you know, going back to that example we did earlier, right? We saw that one trend just go for ages and ages and ages and ages on our game earlier. And then, you know, there's times where it's just a make a buck, lose a buck. And that's really frustrating. But I'm telling you, when you line up the breadth, the signal, all the outlier 9 together, you're way more likely to get those big move trends than the choppy sideways ones. Do they happen? Of course. That happened to me just recently on Apple, on Etsy, on SMCI. That's okay, because I made way more money on the ones that did work. And that's the goal here, right? Way bigger winners than your losers. And if you can combine big winners, small losers with a high win rate, you can make big money. Big money. Because most people balance big wins and small losses with a low win rate, right? A 20% win rate with a 5-to-1 risk to return makes you a profitable trader. But imagine a 5-to-1 risk to return with a 50% win rate, a 60% win rate. We're talking big bucks, big bucks. But it's waiting for the pitch, right? It's waiting for that to come to you. Go ahead, Paul.
Would you make an exception to hold a stock when the market breadth turned down? For instance, I'm reading Minervini's book, and he picked some stocks that broke out and ran for a long time and continued to go up through some bear markets, which I think would probably exit us.
Yeah.
Have you run into anything like that on your own, and would you make an exception?
Well, breadth I actually got from Mark. I never heard about it, never worked with it, never did anything about it until working with Minervini. And he introduced me to market breadth. And once I saw how those two clicked together, the trend and the breadth, was like, whoa, dude, this is a cheat code. Nobody told me about this. So that's why I'm so adamant about it, because most people couldn't even have any clue what that is. But he has a different style, right? He will let a stock run for ages and ages and years and years and years, right? And he just has a different style than I do. His it's funny because his stops on entry are extremely tight, right? If it goes against him a nickel, he's out. He's like, I'm not losing on this trade. But if it works, then he'll widen that stop, right? He'll go down to the 50 EMA. And if it doesn't cross under the 50, dude, he'll just let it go and go and go. No work to do. And that goes back to the gambling mentality. It's like, how can you sit on something when there's other trades to be made, right? Close this one, go get something else. I got to do something. I can't just let this one work. He's been ultra successful because he follows his own plan. And that's the key to this game. That's why you hear me talk about it all the time. Figure out what works for you and do that. And just exploit the mess out of it. Let's do one more question from the chat. Let's see. You guys have any questions in the chat that you wanted to point out while I'm looking through here? Is Outlier 9 trademarked from the scoundrels? Not yet, but we should definitely do that. Then we can send out the cease and desist letters. Let's see. Okay, great question from RRS. Why do order blocks suddenly appear and disappear? How should one manage that surprise factor or the risk of them suddenly appearing after all, it's one of the 9 indicators. Okay, so it takes a few days for order blocks to materialize. That is a fact. So I wanted to share with you the Etsy chart. What do you mean invalid symbol? ETSY. Oh, hang on. Probably one of those. How am I not seeing Etsy? Oh, because I'm spelling it wrong. ETSY. That'd be why. Okay. So look at this, right? I got in and I got out. And on this day right here is when the order block was created. So at the time when I put it in, it did not exist. A couple days later, it popped up. Now, Etsy actually ran, and that's okay because I got out of my trade following the plan. I'm not going to worry about it. I have no FOMO here, right? Even though, would it be nice to be in that right now? Yeah, for sure. But I didn't know the future. Because of this order block right here that materialized and developed while I was in the trade, it's likely that it can use this as support or resistance. And I don't know if it's going to push down. I don't know if it's going to push up, but it just elevated my risk to a point where I am not comfortable at all holding additional risk in this, because I look at trading from a risk first perspective. And by that order block showing up after I'm already in the trade, that's a risk I'm not willing to take. For sure. Great question, though. All right, gentlemen, thank you so much for coming to class today. I really appreciate it. We're getting more and more advanced as we go, as you can tell. Let's see if I have my notes ready for Thursday. Thursday, we're talking about backtesting and journaling. Now, backtesting and journaling, I think, is so critically important, and most people don't even care. Most people couldn't care any less. But I'll talk about why it's so important, why you need to be doing it, and it will help you make you such a better trader, so much better trader. And of course, Dave has an incredible, Dave down here, we're doing the Brady Bunch style. Dave down here has an incredible journal. If you like writing them on paper, I'm waiting for him, I'm plugging him. It's not going to work with your background. He has an incredible book. There we go. The Profitable Trader Strategy Journal. Be sure to pick that up. Oh, look at that. We got several of them here. You guys are awesome.
We're all using it now. On Amazon.
You guys are the best. Look at how supportive y'all are. I'm so proud of you guys.
You left out a best order of copy.
So that was the 5 people who bought it.
We are
very
paid
cool, guys.
actors.
All right. Have a fantastic afternoon. I'll see you right back here tomorrow, and we'll talk soon. Be sure to click one of those videos, but only listen if you want to save time, make money, and start winning with less risk. If you want to lose money and spend extra time and have more risk, by all means, don't watch those. But you should definitely watch them. Talk soon. See y'all.